Hey, good morning, options traders, and happy Monday, everyone. I hope everybody had a good weekend. And when you're in volatile markets like we've been in, and especially here in early October of 2022, you have to back up and say, what are some good strategies we can use? And what happens too many times is that traders start buying options during these high volatility periods. And a lot of times those strategies are going to backfire on you. You need to know how to switch into more conducive strategies when the times call for it. And high volatility is one where you might want to switch into buying the underlying stock and selling the high volatility options. And the reason that that strategy works is that stock is Vega neutral. And a lot of times this catches new traders by surprise because they say, well, wait a minute, how come the options are super sensitive to volatility? That's why they have a Vega component. But why isn't stock? Options are tied to the stock. Why is stock Vega neutral? It's a good question, and let's go find out. As always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always very much appreciated. So let's start by taking a long look at the VIX, the Volatility Index, from 1990 through the current October of 2022. And so we know that the long-term average is right at about 20%. That's the long-term. Volatility just kind of goes sideways, right? It's mean reverting. It can certainly get into some high peaks, but then it pulls back. It can also hit some low lows, but then it tends to come right back towards this long-term average. Now, it turns out that the standard deviation is about 8. So plus or minus 1 standard deviation would be, let's call it 12 to 28. So one standard deviation is 68% of the time. So we know about 68% of the time the VIX is going to be somewhere between 12 and 28. And during these times, it's not really necessarily the best types of option strategies, at least for selling. What about 2 standard deviations? Well, that's going to be somewhere around 4 to 36. Now, don't look for 4 to occur that often. Really, even single digits breaking below 10 is pretty rare. But nonetheless, this would still be plus and minus 2 standard deviations. And notice at 36, even though a lot of times we don't consider that as being very high, you can see that since 1990, just a handful of times that we've actually eclipsed 36. So once you start pushing kind of these mid to high 30s, certainly above 40, you have to say that those are times that we need to start thinking about selling options. You have to be careful about buying them. And if you are going to buy them, you need to do things that are like deep in the money, stock replacement, get rid of the extrinsic value, or at least sharply reduce it. Use things like vertical spreads or diagonal spreads. But to just do a straight up buy of an option becomes a really risky proposition. But another strategy that traders overlook is to buy the actual underlying, let's say the S&P 500, and sell the expensive options against it. And the reason that's a viable strategy is that stock is Vega neutral. It has no Vega component. So let's do a quick review of Vega. Remember that it is the sensitivity of an options price from volatility. So let's say that volatility is trading at 20% and we see a $100 call trading for 5. We look on our broker's platform and it says that this call has a Vega of 0.10. What that means is that if volatility rises 1 tick, let's say from 20% to 21%, that call option is going to pick up Vega, or 10 cents. That call should rise from 5 to about $5.10. That's assuming everything else stays the same, stock price stays the same, everything else is the same. We just see a bump in volatility. So options are sensitive to changes in volatility. That's why they have a Vega component to them. But why is that? Why do options have it, but stock doesn't? Well, if we look at our risk graph, let's say for a $100 call, we get our typical hockey stick graph. And let's put a vertical line right here at the strike. That's the current stock price. And remember that there is always a bell curve over the current stock price. So this is a certain volatility. And if we increase volatility, what's going to happen is that this bell curve is going to get shorter and wider. So we might move from the black curve to the red. And what do you notice is that the wider that the volatility gets, you're not really harmed over here on the left-hand side. You see how your risk graph just flattens out. So once you've paid for the option, $5 in this example, sure, bring on the volatility. because all it can do is increase the potential gains, because notice that we have these unlimited gains out here to the right. So the more volatility, yeah, we just have the potential to maybe make more, but we can't lose anymore. And so that's why it's a benefit for an option to see rising volatility. But now take a look at this asymmetrical payoff pattern, this hockey stick. We have benefits out here to the right, but we only have fixed losses out here to the left. When we look at long shares of stock, that's no longer true. We have dollar for dollar gains, but we also have dollar for dollar losses. So if the stock is right here at 100, we put our dotted line right there, you can see it's symmetrical. Yes, higher volatility can certainly push the stock prices higher, but it can also push it lower. And because they cancel each other, it's not really a benefit to have rising volatility. Same thing would happen for a short stock position. It's symmetrical. See, that's the key insight to understand with shares of stock, is that they are symmetrical. It's just a straight line up and down. For the short stock, we have negative deltas out this way, but it's still symmetrical. Rising volatility is not going to help you, because for every gain that it could possibly give you, there's a corresponding loss. These effects just cancel each other. And so that's why the stock positions, long and short, are not sensitive to volatility. Okay, so why does this matter? Well, again, the big thing I want you to take from this is that during volatile markets, consider buying the underlying but selling the options. Too many times traders say, I just don't know what to do in volatile markets like this. This is why you have to understand things like Vega. When you buy the stock but sell the high implied volatility options, you're going to collect that high implied volatility, but you're not paying for it with the stock. Why? Because stock is Vega neutral. And so once you understand the art and science of options trading, you will see that there is always a strategy to take, no matter what the market conditions may be. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.